A very good evening, everybody. Welcome to the live webinar on what's next for US stocks, key trends, outlook, and top picks. I'm Ming Hui from Phillip Nova, and speaking to us tonight will be our very own senior investment analyst, Mr. Danish Lim. Before I pass the time to Danish, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box, and we will address them during the live Q&A session towards the end. And now, without further ado, over to you, Danish.
Okay, hi everyone. Thank you for coming. Okay, let me share the slides first. Okay, so hopefully you guys can see and hear me. If you guys can't hear, just do leave in the comments. So today I'll be just sharing, some of our outlook and our top stock picks, specifically for the US market. So just before we proceed, this presentation is intended for general circulation and educational purposes only, because we do not take into account your specific investment objectives, your financial situation, or your financial needs. So this is a rough agenda of today's webinar. I will try my best to cover, everything. There's a lot of content today, so do perhaps have some your phones nearby so you can snap a picture. And there is a little bit of quite a bit of economics and things uh, involved or included in today's webinar. So I will try to very quickly skim through this, because I do want to address the part 3 and 4, which I believe are the main areas that most of you guys are interested in today. So just to start things off, I believe all of us know that the US market has been very, very volatile recently. You can see from this chart in Bloomberg alone that in terms of volatility, mainly in terms of the daily range of percentage moves, meaning what's the range, how high or low the price movement is in the S&P 500. The volatility wise, it's even higher than 2020, and all of this is actually caused by a lot of tariff uncertainty, fears about recession, as well as the AI boom that has somewhat faded out. And we saw the sort of peak on April 7th after China retaliated with their tariffs on US products. So just the market snapshot so far this year, the S&P 500 has underperformed most major indices. Throughout earlier this year, the best performing equity indices were actually Europe and China. But you can see that sometime around April 7th or so, even both the two best performing markets were unable to survive the Liberation Day tariffs. We also saw somewhat of a recalibration of a lot of our investors' playbooks. There's a lot of rotation towards defensives and safe haven assets like gold. So just the sector snapshot for 2025 year to date. This chart or image I took over here is as of 23rd April, just yesterday. You can see the top and the best and the worst performing sectors in the S&P 500. And I think the theme is that so far there's a preference for defensive stocks. You can see some of the more defensive sectors like consumer staples, utilities, healthcare are the best performers. So just to go through some of the specific sectors, we see that defensive sectors like staples, utilities, who provide investors with very stable cash flows, they actually benefited because of safe haven demand. Investors essentially just rotated to defensive stocks. So some of the best performing stocks include like Philip Morris. They essentially sell tobacco, Coca-Cola, Oreo maker, Mondelez, as well as Monster Beverage. And you can see in third place over here, real estate is essentially flat for the year. And mainly this is because they actually saw a rally when I think around late March, when markets started to price in more rate cuts. But I think this has recently reversed because the markets are pricing in about 3 rate cuts this year. And even in real estate, we see that more defensive real estate or more defensive REITs, for example, Welltower, Ventas, they outperform some of the more cyclical REITs like, data center REITs like Digital Realty and Iron Mountain. And for financials, it's in fifth place or so. It actually performed, I would say, pretty well. But you may be surprised that the best performing subsector in financial is actually insurance. And this is because interest rates, relatively right now, they're still pretty high at about 4.25%. and they actually help to boost what we call the float income. So if you guys are aware, how insurance company work, that they typically take in premiums from all the insurance policies, and then they essentially pull all these premiums together into what we call float, and then you invest that float out into money market funds, bonds and interest deposits and other things of that nature. So when the interest rates are still pretty high, their float income or the investment returns from this float are actually higher. And on the other hand, banks, they face what we call a net interest margin squeeze because interest rates are still pretty high. This means that they need to pay more interest on your deposits. FD, their rates are still pretty high, so this somewhat affected banks negatively. And some more, sector insights. We see that insurance brokers actually outperformed insurance writers. I'm not sure if you guys have actually heard of insurance brokers before. They are essentially, like a middleman between the consumer and the insurance company. Typically, they, pretty much serve like corporations. They don't really serve as much, I would say retail people. Some US companies or insurance brokers are like Arthur J. Gallagher and Brown and Brown. So they are what we typically consider to be more defensive, mainly because they do not bear any like underwriting risk. Most of their revenue comes from fees, because they are insurance broker, they are middle person. There's no risk of clients essentially claiming their insurance. So the more defensive insurance brokers are performing. Exchanges as well, like ICE, CME, CBOE. They're actually seeing more revenue from like hedging. They also generate fees. Most of their revenues are from fees. For example, brokers will pay exchanges for market data. So more volatility as well. They'll benefit exchanges like ICE who sell derivative products. So again, in finance, I would say the financial sectors, it's quite interesting that banks aren't the best performing. Materials as well. Some of the best performers include gold-related stocks like the gold miner Newmont Corporation. It's up about 47% year to date. But on the other hand, stocks with very, very high foreign revenue, like lithium producers, plastic producers, all of them are some of the worst performers. You can see that Albemarle, for example, they generate about 90% of their revenue outside the US, which makes them very highly exposed to tariffs. For energy, they actually suffered because crude oil prices are pretty low. I think just today was about $62 or so. But we see that some of the more, I would say, a little bit more defensive big oil companies like integrated oil, like Exxon, Chevron, as well as natural gas companies, they actually performed better as well. So a very unique company that I want to share is Texas Pacific Land. So their model is pretty unique. They don't actually engage in any oil or gas production. They simply just lease the land out to other fellow oil and gas producers, and then they earn essentially royalty fee. So they don't have to take on any operating risk. And I think last year it was actually either the second best performing or the best performing stock, just just right behind Nvidia last year. And after that, we also saw the industrial sector. Some of the defense stocks benefited, like General Electric, RTX Corporation. But airlines like Delta and United Airlines, they actually underperformed because a lot of people are concerned that due to the tariffs, and this will result in economic concerns and a recession, and people will essentially spend less on, flying overseas. Regarding communication service, it's down about 10% year to date. We see that telcos, AT&T, Verizon, as well as software companies with very, very strong IPs like Netflix, Take-Two Interactive. Take-Two Interactive, not sure if you guys are familiar. They are actually the publisher of GTA, Grand Theft Auto games, as well as like NBA 2K, for example. So all these are they would they are seen as being more defensive, more stable, and they outperform more of the cyclical advertisements focus like companies like Alphabet as well as Disney. And for tech, I don't think I have to talk much about it. We all know that semiconductors this year are performing very, very badly. Not just because of DeepSeek, which I will address later on. Nvidia is also recently seeing some export restrictions, and hardware companies as well like Apple and Dell also suffered due to tariffs. An outlier here is the company called Palantir. They're an AI company as well, but I think it's seen to be a more defensive tech stock, mainly because about more than half of their revenue comes from the government, or specifically the Department of Defense. So most of the AI is like software businesses or software related, and they are more related to things regarding the military. So now the very last sector, the worst performing sector this year is the consumer discretionary sector. Retailers like Nike, Lululemon, cruise stocks like Royal Caribbean, hotels, and even US automakers. All of them underperformed. But again, we see that this trend or the theme of a preference for defensives remained. As of 23rd April, McDonald's is one of the best performing stocks, at least within the consumer discretionary sector. So something to keep in mind as well. Moving forward to the second half, this defensive preference could change, but I don't think it will change that much given all the uncertainty surrounding tariffs. Now moving on to the second section, I'll talk about some of the key macro themes so far this year. Now, the first thing I'll talk about is tariffs. Of course, this chart over here, uh, it was essentially released during the Liberation Day itself. So it's actually gained quite a funny nickname. It's been called the chart of death, mainly because it resulted in a market crash. So just to address a question, I think some of our clients sometimes ask us why is the US or why is Trump so insistent on tariffs? There's a lot of reasons. One of them is that they want to relocate factories back to the US. Companies like TSMC, Samsung, Intel, they have reportedly stated plans that they will build factories in Arizona and Texas, and also partly also because they want to avoid some of the tariffs. And I think a very important reason is what we call the job creation. When they relocate factories, this will open up room, more jobs will be created. And this is very important because the US historically, is there's essentially a bunch of states, states like Michigan, Detroit, Pennsylvania. All of them used to be known as the steel belt or the industrial belt. Detroit, for example, the state was very famous essentially for producing cars, producing Ford vehicles and other industrial goods. But then as we moved along, sometime around 1960s, 1970s, we see that a lot of these companies, they, instead of manufacturing domestically, they move their manufacturing overseas. Companies like Apple, companies like Ford, they move their factories to countries like Mexico, mainly because, the labor cost over there is a lot cheaper. And it's very important because all these countries around what we call the Rust Belt, Detroit, Pittsburgh, Pennsylvania. If you guys monitor the US elections, some of these states are what we call swing states. I mean, what we say swing states means that during any particular election, they have a very huge role because they are not seen as I would say completely Republican or completely leaning Democrats. So we call it swing states because there's a very high likelihood that whoever wins those specific states will win the election. Important as well because a lot of these workers in all these states, they essentially lose their jobs because factories are moving overseas. So of course we have other reasons as well. Supply chain control, national security. One key reason is that tariffs provide funding for tax cuts. Again, tariffs are a cost on the importer. So let's say Ford imports, car parts to manufacture cars. They don't pay, it's not paid by the other party. It's paid by the company themselves, and that extra money or the tariffs actually goes to the government. So of course, the pros are that it's helped domestic companies, and the downside is that it could result in higher inflation, which could result in recession. Now, I won't elaborate too much again for all these, tariffs. It's constantly changing every day. We had what we call the Liberation Day tariffs. You can see some of the tariffs. I've essentially took a screenshot over here. Something that's quite interesting is that countries like Cambodia and Vietnam, the tariff rates are actually higher than China on the day itself, or the reciprocal tariffs. And one reason is because of what we call the C+1 or China plus one strategy. A lot of companies, they actually anticipated all these heavier tariffs on China. They started to move some of the factories to other countries like Vietnam, like Mexico, Cambodia. I think, for example, Nike, I think 50% or so of their goods are made from Vietnam. Something interesting as well is that not long after, Trump actually announced a 90-day pause for tariffs, and this resulted in stocks, essentially rallying by the most since 2008. And we think that because of this, what we call the Trump put is still alive. This is very important for our market view. I'll explain more later on. Now, tariffs on China now are as high as 145%. So recently as well, he's essentially said that he'll exempt a range of consumer electronics, including iPhones, laptops, and chips. But I mean, you can see from this screenshot I took of his post on Truth Social. There's constantly a lot of flip-flop between whether certain products are getting exempted or not. He said, however, that this is exemption is temporary, but still remains to be seen. There are upcoming tariffs he mentioned that is on pharmaceutical products and semiconductors. And more recently, I think he said that for Nvidia to export some of their China chips like the H20 GPUs, they will require an export license. The company warned that this could cost them about $5 billion. And all this is very uncertain. It's very important because businesses, due to the uncertainty, they will hesitate and then they will pull back their investments overseas. They will start to build up their cash reserves, and all this will affect the global economic growth as well. So some of the winners and laggards throughout this whole tariff tantrum. Some of the winners, of course, haven assets like gold, domestic linked companies. We have a Japanese company over here, Ryohin Keikaku. Not sure if you guys have heard of it, but it's actually it's actually Muji. Muji, we are very familiar with them in Singapore. It's actually one of the best performing stocks, and one reason is because less than 5% of their revenue is generated from the US. You can see that 5% is from Europe and Americas, and if you narrow it down to the US, it's probably about 2 or 1%. We also have Disneyland operator Oriental Land. Uh, if you've been to Japan, I'm sure you've been to Tokyo Disneyland. Their revenue is essentially purely generated domestically. I know S REITs, Singapore REITs like CICT, they also generate a majority of their revenue domestically. China A shares, when we say A shares, we mean that they are essentially Chinese companies that are not listed in Hong Kong, but they are listed in the exchange in Shanghai and Shenzhen. So we have companies like Tsingtao as well as Guizhou Moutai. And all these companies have won the tariff tantrums mainly because they generate a lot of their revenue domestically. And then on the other hand, with the laggards like Nike, Abercrombie, and Lululemon, Nike makes about 50% of their footwear from Vietnam, Lululemon about 40%, and Apple as well. So again, there's a lot of winners and laggards that we see due to the Trump tariff tantrums, but I think the theme again is more defensive and more domestic, linked companies that generate a lot of revenue domestically, like Muji, CICT. And now more recently, I think over the past few days, I think I added this slide just this morning. We are seeing, quite a softer tariff rhetoric. More recently, Trump said that he will essentially be very nice to China and that the final tariff rates will not be anywhere near the current 145% level. And we see that over the past few days, because of all these tariff developments, the S&P 500 actually jumped by I think yesterday about 2.2%. This wasn't only said by Trump, his Treasury Secretary has mentioned roughly along the same things. And all this, I think, serve as a catalyst for a stock market reversal. However, something to note is that negotiations with China haven't officially started. And I think, it's I would say pretty weird because Trump has said that he has signaled or indicated that he's actually waiting. He wants China to start approaching him instead of him being proactive in taking or like negotiating with the other party. Other than that, there's also a lot of positive developments. The White House is close to deals with Japan and India, as well as it's preparing for talks with the UK. So all this is very important to watch because it will result in a reversal. So for our views, we think that investors would be wise to really just prepare for the worst. There's no harm in aligning, revising, reallocating your portfolios just to prepare for the worst case scenario. You can see this chart over here that the S&P 500 has literally moved whenever Trump advisors speak. Essentially, whenever Trump says anything, the stock market will move, and this is not what we want. This makes investing very, very unpredictable, and investors are essentially just investing, based on noise, based on what they hear, and fundamentals are essentially thrown out the window. And and what we say that this his style of policy making is very risky because Trump has historically shown a tendency to do politics in a way where he wants to escalate things, and then from there he essentially de-escalates the situation, come to compromise, make deals with partners. And really the only certainty moving forward, we think, is uncertainty, which is why we think investors will be served better if they prepare for the worst. And I think, if you guys have watched, our PM Lawrence Wong, he did a talk recently, the Smoot-Hawley Tariff Act in 1930. We think is really the worst case scenario. And back then, actually, there was a Great Depression, and I think it's pretty similar to today as well. A lot of the domestic, American workers back then, especially regarding agriculture, I think it was corn or farmers or uh, those, they essentially started losing a lot of their jobs, and they essentially just campaigned and then protested, asking the government to do something to protect domestic jobs. So the US back then, they essentially then imposed tariffs just to protect domestic jobs, but it became worse, and it even it made the Great Depression even worse, mainly because other countries started to retaliate, and then it resulted in a trade war. Countries started to devalue their currency to increase their exports, and that's the worst case scenario. And more recently, we are seeing companies start to, uh, uh, you know, cut more jobs. Intel, I think a few days ago, said that they will cut more than 20% of their staff. So it's very important just to have a clear presence of mind and really prepare your portfolio for the worst case scenario. And something we want to say as well is that we don't think there is any market bottom, at least not until any actual trade deals are signed and tariffs are actually lowered. Whatever I've mentioned, they are essentially just talk. There's no solid, positive development so far. No actual trade deals have been inked, and the markets are essentially right now just trading off of tariff and tweets. What happens next? The other deadline after the 90-day pause or the 3-month pause, the deadline is about early July. It could be another deferment, or it could essentially reimpose the original tariffs. Again, there's a lot of speculation. I won't go too much into it. The Wall Street Journal said that China tariffs could be a tiered approach, essentially 35% tariffs on items not critical to national security, 100% on those that are. But again, all these are, I would say, speculation at this point. And there's a lot of things, but I think the recent rhetoric does suggest, given that Trump has somewhat softened his stance, that the worst case scenario can be avoided. But volatility will definitely remain elevated, given how unpredictable Trump is. More fundamentally, tariffs will very likely generate a short-term rise in inflation. It could be transitionary, it could be very short term, but there's a risk that it becomes a more persistent price inflation increase. But this all really depends on what the Federal Reserve does. And just to end off, this is a chart over here. You can see how much the tariffs on US tariffs and China's tariffs have changed. Right now it's 145 and 125. So the next theme will be whether a recession will happen or whether something worse will happen. And really, the underperformance of the stock market isn't really just about tariffs. Again, markets are feared. There's actually higher odds of a recession. You can see in this chart over here, it's essentially this data over here essentially counts the number of times the word recession is mentioned in all news sources, all social media posts. You can see that it's essentially peaked. It's almost as high as it was back in, I think, 2020 or 2021. 2020. And this resulted in lower 10-year yields because markets are pricing in more interest rate cuts. A lot of the tech stocks also have been overbought before this market slump, and a lot of fund managers, institutional investors as well, they have been unwinding their long positions, and they've turned very, very bearish. This is essentially the equity exposure. You can see that they've cut their equity exposure to the lowest so far this year. This was as of, I think it was early March. The latest data, if I'm not wrong, is probably around the 2024 low. And there's also, fears that this Trump put, and we say Trump put is the concept or the idea that Trump, if the stock market declines too much, he will come in and intervene in the markets just to, save the markets, and which is what we saw. But there's also fears that, Trump essentially is willing to see the stock market suffer just to achieve his goals, his tariff-related goals. So it's really not just tariffs that's driving the market lower. Something that's worse than recession will be what we call 1970s stagflation. How you can think of it is just stagnant growth plus inflation. Just take a look at the data. Currently, the CPI 2.8, unemployment 4.1, real GDP growth 2.5, Fed fund rates at 4.25 to 4.5. You can see during the stagflation period, inflation was very high, and GDP growth was negative or close to zero, and unemployment is very high as well. So it's the worst case scenario, because when inflation is high, the Fed needs to keep interest rates high. But if they were to keep interest rates high, it will essentially accelerate the poor economic performance. It will accelerate the negative GDP growth and increase unemployment. So this is the worst case scenario, and during such a scenario, usually everything will drop, stocks will drop, bonds will drop. The only positive asset class will be gold, which is why we recommend gold as well, because gold outperforms in both a recession and stagflation scenario. I won't elaborate too much as well. It's very different dynamics. Back then in the 1970s, there was the Iranian Revolution. This resulted in oil embargoes in the Middle East. So this caused oil prices to surge. The gold standard or the Bretton Woods was ended as well. And something important to highlight is that there was a lot of political pressure by President Nixon on the Federal Reserve, and they actually cut rates too early. Despite inflation still being pretty high, and then because they cut rates too early, inflation actually re-accelerated upwards, and this caused the Federal Reserve to hike interest rates to an all-time high of about 22%. So just imagine, interest rates being hiked to about 22% just to control inflation. And this was what we saw in the 1970s. And, it's really just the worst case scenario that we wish would not happen. So some red flags are, stagflation signals. If you guys monitor the markets, just monitor, whether the core PC inflation, whether it remains above 3%, whether it's sticky, if Q1, Q2 GDP growth is less than 1%, hovering around zero, stagnant economic growth. If unemployment rate increases, whether there's any, external supply shocks, crude oil prices, whether crude is above 90. Thankfully, right now, the crude price is about $62 only. And importantly as well, whether there's political pressure or whether the Fed will cut rates prematurely. Something to highlight is that during times of a recession and stagflation, the traditional stock bond negative correlation turns positive. Essentially, during normal market functions, the stock and bonds, they usually have a negative correlation. But during times of crisis, asset classes tend to move in the same direction. Essentially, everything will fall. Stock will suffer, bonds will suffer, and the only thing that will somewhat survive will be gold as an asset class. So the third theme will be the Federal Reserve. If you guys have monitored the markets, there's a lot of interesting developments. But overall, after analyzing and looking at all the policymakers' comments, we do see and we do think that they are leaning towards inflation control. So the Fed actually has, I would say, a dual mandate. So they have two missions. One is to, keep inflation under control, and the second is to prevent essentially prevent the labor market from becoming worse. So again, there's a lot of confusion. I think they, you can say that they're stuck in a hard place, because if they keep interest rates high, the economy will, stagnate, will start to slow, and more job losses will happen. But if they keep interest rates high, they essentially give themselves more room to control, tariff-driven inflation. So they did say that they are waiting for greater clarity, and they want to observe the impact of tariffs before they actually adjust their interest rate policy. And more recently as well, something that I really dislike is the fact that Trump actually is stepping in, and he's essentially putting the traditional independence of the Federal Reserve in question. He's threatened to essentially terminate and fire Jerome Powell, but of course he did reverse course, but I think reports have said that he only reversed it only after he spoke with some of his advisors. Something to remember as well is that his term will end in May 2026, and this is a very important date because this is when the midterm elections will occur. And historical record suggests that political interference resulted in poor monetary policy, like I mentioned in the 1970s, which ended up resulting in stagflation. And again, really, any reduction or if the Fed loses their independence, which essentially means that monetary policy will move according to what Trump wants, and this runs the risk of inflation rising more than expected. So again, it's not a very good scenario for the overall stock market. And our view of the whole Federal Reserve situation, again, I think after the reciprocal tariffs came out, markets started to price in 5 rate cuts because they were expecting a recession. So real estate rallied, but after the tariffs were paused, they essentially repriced back to the original 3 rate cuts or 2 rate cuts. You can see in this chart, only about 325 basis points rate cuts are now priced in by early 2026. So again, we expect about 2 to 3 rate cuts unless unemployment significantly increases. There is a risk of stagflation if they were to essentially crumble under political pressure and cut rates too early. And just a side note, I think sometimes people ask why does Trump want to cut interest rates. One reason is also because he wants essentially a weaker US dollar so that he can boost US exports. Because he wants to essentially balance out the trade deficit. And again, there's a lot of things. So Trump did say that he doesn't intend to fire Jerome Powell, but he did add a small little statement. I was not really a small statement, but he still wants essentially Powell to cut interest rates earlier. So it's something important to keep in mind moving forward as well. So the last theme, hopefully I'm not dragging this on too long, is what we call an unwinding of the AI boom. You can see last year, a lot of the Magnificent Seven and the AI related stocks or companies did very, very well. But so far this year, they actually are some of the worst performers. They are seeing very, very big losses so far this year. So just a little background on the AI boom. What really, really drove all the AI stocks is what we call capex, capital expenditures. All these capital expenditures actually goes to building out data centers. Data centers require a lot of investment from companies. They have to essentially buy the land, buy the servers, buy chips from Nvidia to essentially put it in the server. And essentially they need to pay for energy supply as well. And a lot of the capex come from tier 1 cloud service providers like Microsoft, Meta, Google, and Amazon. And this is why last year we saw this whole AI capex resulted in a multiplier effect. Semiconductors benefited, energy providers benefited. There's a particular stock called Vistra. They essentially provide energy to, I think, data centers. I think it went up over 100% last year as well. And as well as real estate companies that essentially lease out data centers. All of these benefited last year. But of course, it changed a lot. DeepSeek basically just showed that, they could create AI models that performed just as well as OpenAI, or even better with less resources and at a cheaper cost. So essentially, they just put to question whether all the heavy AI capital expenditures, all the investments by big tech, whether it's worth it and whether they are redundant. I think the Alibaba chairman also recently warned that there is a risk of a data center bubble where companies are building too many data center projects more than it's necessary. And I won't go too deep into why DeepSeek was able to do what it did. There's a lot of technical terms, I forgot what it's called, mixture of experts, chain of thought, reinforcement learning, and distillation. All of these are very innovative I would say innovative techniques that DeepSeek use to produce AI models that perform as well as ChatGPT at just a fraction of the cost. So something to really, really understand if you want to invest, I would say more smartly in the AI and tech space, is what we call the training and inference segment. So when you build an AI model, the first thing you have to do as a company is to train your AI model. This will be like essentially a student studying for an exam. And how do they train? They essentially teach and build the model using tons and tons of data. So because of all this data that's required, very, very powerful chips like NVIDIA's GPUs are required. Chips that have very, very high computing power to essentially help the model process data and learn as much as possible. Cost-wise, it's a very large one-time capex investment. You can see over here, the amount of text used to train the earlier model of ChatGPT will take a human over 2,600 years, to read non-stop. So imagine reading something every second of your life, or every second of your life over 2,600 years. That's how long it will take a human, uh, to achieve as much training as ChatGPT did. On the other hand, once you have finished training your AI model, we proceed to inference. This is very similar to studying and then taking the exam, where companies will apply this trained model, apply to real-time data, and essentially every time you use ChatGPT, every time you use DeepSeek, for example, you are essentially involved or involving the model in the inference stage, and every time you use ChatGPT, there's what we call an ongoing recurring expense in terms of cooling, energy resources, and it could be very, very small. It could be like for every input or every input you use ChatGPT, it could be as low as 0.1, uh, 0.01 cents. But just consider how many times people use it per day. There could be billions and billions of queries. So even if it's like 0.01 cents, if you times a billion, that essentially adds up very, very quickly. And this really presents a problem for companies if they want to scale up their AI, if they want to scale it up and monetize it, to the masses. So because of this recurring cost, um, this is why inference requires different types of chips. They require, I would say, custom chips that are essentially more cost efficient and use lower electricity, and customizing the chip just for a specific purpose. And what this is what we call custom ASICs. I think a company called Broadcom, if you guys know of it, Broadcom actually makes custom chips for big tech companies. And all these ongoing costs can be monetized by charging directly through API fees or indirectly through ads, commerce, e-commerce, and things like that. And inference is very, very important, especially as we move on to the next stage of AI, because it essentially creates monetizable output, answers, ads, contents. It's far more monetizable than the training phase. So hopefully you guys understand this difference or distinction between both phases. So just to elaborate more about DeepSeek, before DeepSeek came out, it was thought that only big tech could afford, the massive amounts of money to train models to spend on very, very expensive NVIDIA GPUs. There was a thought that their models were the best because they trained them better. So there was a very high barrier to entry, especially if you're new, you're a small startup, you want to build AI products. And developers, enterprises essentially need to outsource AI. They essentially have to pay OpenAI money, pay them API fees just to essentially use ChatGPT or integrate ChatGPT into their products. However, after DeepSeek came out, again, it essentially showed that training and inference can be done a lot cheaper while having the same performance as ChatGPT. Uh, Developers are now not required to train their models from scratch because of what we call a distillation process, where essentially they'll use a larger AI model. And the AI model will be like the teacher, and the smaller AI model will be like the student. So you're not essentially training it on historical data, you're using a larger model to train a smaller model. And because DeepSeek is open source, a lot of developers can use it without paying for the huge amounts of money to train their specific AI models, paying for API. They can build their own AI applications. They can even run them on your own personal GPUs. And they're really moving forward. DeepSeek and open source, distilled or pre-trained models really help to lower the barriers to entry. After all, why should if you're an AI startup, should you pay for access to a closed model like ChatGPT when you can run something almost as good by yourself? You can run powerful AI models by yourself because models like DeepSeek are open source, meaning anyone can access it, anyone can use it, and then you can essentially just fine tune the DeepSeek model according to your own business needs. So because of this, there's recently a more focus. The focus has shifted towards lowering the recurring inference costs. Remember, I said that every input you make for example, ChatGPT comes with a cost for the business. So it's very, very important. The next phase of AI and what we see in the markets, they're really, really focused on cost efficiency and really lowering the recurring costs of the inference phase of AI. So again, I'll start to run through this a little bit quicker. So again, before DeepSeek came out, if a company wanted to build an AI product, they had to train their own AI model by essentially just paying, renting computing power from cloud service providers using like Microsoft Azure, for example, or they buy access to proprietary models. They have to pay API fees. Essentially, you pay companies like OpenAI fees just to use their AI model. And big tech, for example, they made money and their AI models weren't open source. We call it closed AI, meaning not anyone can just take it and then use it and then edit them or like refine the AI models for their own use. And really, before this, how big tech earn money, for example, I think it's a very good example. For example, let's say company X, you train your own GPT model using Microsoft Azure. Microsoft earns the revenue from training, and if ChatGPT, it's you serve it in your business via your API, Azure hosted API, which essentially gives you access to the AI model. There's also ongoing inference revenue. It's a usage-based billing. When you pay APIs, it's essentially recurring revenue, and also Microsoft can also integrate the AI model into their other products, which presents additional monetization. And the key, thing moving forward is that open source models like DeepSeek essentially allows developers to use AI for free, run it without needing any API access, and because it's a lot cheaper, they can run it locally on their own server. And then the key risk for big tech is that it will compress margins because companies essentially will stop paying Microsoft, for example, all these forms of revenue because developers can build their own AI models without relying on the closed AI models that big tech provides. So what does this mean? Again, margin compression. You can see over here, Nvidia, Broadcom, their margins are very, very, very high. Apple is about 46, Nike is about 41, but Nvidia is as high as 73% gross margins. Broadcom's about 68%. Compared to a company like Walmart, it's at 24%. So I think something I like to highlight again that this my biggest fear is that we'll what we see happened in other industries could occur in AI as well. For example, I'm not sure if you guys are aware, when Tesla first came out with the first modern electric vehicles, their margins were actually trading almost roughly in line with companies like Apple, Nike, about 30-40%. However, their margins now, I think, is as low as 17-16%. Why? Because Chinese companies like BYD essentially came into the market and could outmanufacture Tesla, produce similar performance electric vehicles at a lower price. And then what we saw end up happening was that in the EV space, a lot of electric vehicle companies, Tesla, BYD, Xpeng, for example, all of them started to lower price, resulting in a price war. So Tesla started out, margins about 30%, now it's about 16-17%, or even 20%, if I'm not wrong. And that's one of my biggest fears as well, that Nvidia's, Broadcom's, their margins could eventually come down just like Tesla did. So again, our view for AI 2.0, AI, again, we can see it as training, the chef training large foundational AI models. Players will be essentially companies that provide the hardware. Nvidia, Broadcom, Vistra provides energy. And for AI 2.0, once you train the chef, the focus will be on essentially opening the restaurant, serving customers, trying to get customers to come. So the key in this next phase of AI will be monetizing at scale. Who can monetize their AI model at the largest scale possible. There's a lot of ways like subscriptions, software as a service, e-commerce, advertising, and it's very important for them to have smaller, faster models as well, especially for, let's say, you're like a EV company, like Xiaomi or Xpeng. You want to essentially integrate AI into your vehicles. You need models that can run offline because whenever, let's say, a vehicle goes through a tunnel, if when it goes through a tunnel you won't have internet connection, and it can't be possible that AI stop working. So this calls for a very very different types of chips, and this is results in demand for what we call edge AI chips. And when you say edge, essentially it means AI that runs on your local devices, like your smartphones, like your vehicles, and it doesn't run on the cloud. So players in this space will be more consumer companies that are closer to the consumer, like Meta, Apple, and Microsoft. So again, the focus for the next phase will be lowering your recurring cost per use, companies that can best monetize through the different ways. So the winning formula, we believe, at least in our opinion, will be companies that can best, monetize AI at a large scale, those that can embed their AI directly into the products, in their vehicles, advertising, edge AI as well, which I mentioned. Essentially, you bring AI to your devices, and they don't run on the cloud, for example. They run locally on your device, like your phones, Xiaomi. For example, AI where it's integrated in your smartphones, and then what we call AI super apps, where just one AI model powers many many use cases. So, what are some clues to pick out the next, AI 2.0 winners? I think, China has already been, they're essentially ahead of the game. They've already picked out some of the key, AI 2.0 winners. You can see there's a lot of different categories. Edge AI devices, Xpeng, Xiaomi, companies that produce chips for essentially all these edge AI products. Horizon Robotics produce chips for essentially cars. Then we have enterprise AI software like Kingdee. It's very similar to your Microsoft, AI agent, where AI essentially helps improve business productivity, and super apps, applications like Alibaba, Tencent, Kuaishou. All of these essentially have very very huge, user bases where they integrate AI into all different forms of monetization avenue like e-commerce, live streaming, search, and personalized advertisements. So what are the US counterparts? I think this is quite a good comparison as well. For example, edge AI devices, we have Apple, who's trying to integrate Apple Intelligence, Tesla, who's trying to integrate full self-driving into their cars. Edge AI chips, Qualcomm produces chips for smartphones. I think it's essentially making chips for Apple. And then we have enterprise AI software like Salesforce, Microsoft, where their customers are mainly corporate customers, and then super apps like Google and Meta. So I think this is a clue as well. If the market recovers and tech starts to again gain some momentum, these are some of the companies that could start to outperform. So now we'll move on to, I think, the more exciting part, US market and our index target. So again, I mentioned that the main driver of the market, US market, the main thing that's weighing on the US market is not just US tariffs, and it's really mainly just because Trump has shown a more, I would say, a lack of a concern for how the economy or stock market does. You can see that in his first term, he made about 156 mentions of the stock market and 60 in just the first year. This time up to March, at least before the recent market crash, he's only mentioned the stock market once, and he has said that there will be an adjustment period, essentially some short-term pain for long-term gain. But recently as well, this has reversed, so things still remain very uncertain. It does seem that he's more willing to rescue the market, but at a different price. He's essentially being less sensitive to stock market movements. Um, so I think we do think that this Trump put it does still exist, just that at a lower level. And just before the biggest reversal on 10th of April, the S&P 500 went below the 5,000 level. It closed at about 4,982. So this gives us a sense of a possible level where we think Trump will start to intervene in the market, either around the 5,000 or 4,900 level. And other than that, when you look at all the different factor-based investing, a very key theme that's outperformed or done well this year, you can see in this purple line over here, what we call low volatility, the low volatility factor. Essentially, it refers to stocks that are the calmest. Their prices don't really move that much. Their prices aren't very volatile. It's actually just very, very calm stocks. And doing some filtering and like data filtering, these are the list of some of the most calmest stocks in the market. It includes companies like Procter and Gamble, Coca-Cola. So all these, their stock prices aren't very volatile. It tends to move in very, very small increments, similar to what you see in the STI. And really, low volatility stocks are actually beating the broader market in 2025. So this is the stock list, and it's something that we keep an eye on as well to see, look for opportunities that we can invest in. So this is our US projection. Our main projection is that we think moving forward, markets will be range bound about 4,900 to 5,800, and our year-end target is somewhere in the middle, about 5,600. So we think that the lower bound of our target range, about 4,900, is where Trump will definitely, try to intervene, and where he could, do a tariff pause as well, because this is the level where the S&P 500 is down about 20% from its peak. And this is where we typically say that the stock market has entered a bear market. So this is a very important level to measure, about 4,900 or so. The range between 4,900 to 5,000 is a very important level to measure, to watch. However, any technical rebounds that we see could be short-lived, just like recently. If there's no clarity on negotiations or actual reduced tariffs, it wouldn't surprise me if just maybe tomorrow or maybe a few days later, Trump announces extra tariffs on China and the stock market starts to reverse back down again. And we do have different scenarios as well. Our bear case, in the worst case scenario, is about 4,000. Bullish case will be it goes above our range, above 5,800. But we think this does require, a trade deal with at least Europe and Japan, and at least lower tariff rates on China. So some macro explanations. We do think Trump is still cognizant of the stock market. It's just that it's a lower sensitivity. Again, the 4,900 level is what we'll watch. We do think that one of his main goals is that he's currently aiming to front load some of the less market friendly policies like tariffs, immigration, and the Doge government policies. However, we do think that he will most likely backload their pro-growth, business-friendly policies like tax cuts, deregulation. I think a lot of people have forgotten that what actually pushed the market up in the first place when Trump was elected was some of these pro-growth agendas like tax cuts, deregulations. We do think that he'll backload it probably around the fourth quarter of 2025, just to better position his administration for the 2026 US midterms. This is why I said this date is very important, because it coincides roughly around the same around the same time period where Jerome Powell essentially ends his term as a Fed chair. And why we say this is because if you look at pre-election polls, his voters, tariffs hasn't really been some of their top priorities. It's pretty similar to Singapore. Some of the key concerns have always been inflation, and for US like immigration and jobs. So again, the Trump put we think is still alive. Tariffs will definitely affect the economy, but we do not predict a US recession. But again, we don't have to see a recession actually happening, because markets they are very forward looking. They may just price in a recession anyway, and then this will trigger safe haven flows and safe haven assets like gold, as well as some of the more defensive stocks which I mentioned earlier, like insurance brokers, companies like Coca-Cola. Some of them will benefit. So this is our multi-asset view, venturing just beyond the US market. And from a more portfolio perspective, we do think it would be wise to stay, cautious in risk assets, especially where, things like Bitcoin, crypto, and perhaps as well as your equity holdings as well. Do not, recklessly invest in like penny stocks, for example, at least until recession and tariff clears up. But we do think it'll be very wise to just keep some cash on hand, very similar, to what Warren Buffett does. He likes to keep a lot of cash on hand, and then use that cash to just dip buy if the market starts to recover. And when we say dip buy, dip buy some of the more high conviction stocks, stocks that have been beaten down, stocks that are down like 20-30%, like Nvidia or so. So, some tactics we think would be good during this time will be diversification, not only, in terms of sectors, in geographic diversification as well. There are a lot of different ETFs out there. There is China A50. Again, these are essentially tracks Chinese stocks that are listed in China, not in Hong Kong. So their shares and most of the A share companies, their revenue is mainly generated domestically, so they're more defensive. However, let's say you want to use your extra cash to essentially buy, and you see tariff de-escalation coming soon. Offshore Chinese stocks, like the Hang Seng Tech ETF over here will perform better because they're more tech heavy. If you want a more balance, somewhere in the middle, there's a China Leaders ETF where 60% of it is made up of A shares, 40% is in Hong Kong stocks. Of course, earlier at the start of this presentation, I talked about Europe. Europe was, I think, just behind China. It's one of the best performing stock market. They have a lot of their own factors that's driving the stock market higher. The country, like Germany, for example, they're spending more on defense. And there's some very important catalysts in the potential for Ukraine ceasefire. Of course, it will be wise to hedge your portfolio with S-REITs, because if rates were to get cut in the event of a recession, S-REITs will benefit because their relationship with interest rates, they have an inverse relationship with interest rates. Of course, recession and stagflation hedge could involve your gold ETFs. Again, the defensive sectors. If you guys just want a very easy exposure to defensive sectors, there are sector-specific ETFs, like consumer staples sectors, and something perhaps more advanced. If the market is range bound, like we expect, the best one of the good tactics to use will be covered call ETFs, where you essentially just write calls on on stocks, and then you generate additional income. Of course, domestic linked equities like Muji, also you can invest. The low volatility factor, which I mentioned. And for bonds, we like TIPS, treasury inflation, essentially bonds that give you a hedge against inflation. If inflation rises, these bonds will rise as well. Of course, for gold, we would definitely suggest to increase allocation. I think there was another seminar I did where we found that the ideal allocation during this time period will be about 15 to 20% of your portfolio. Gold miners, stocks, as well as individual stocks, like Newmont Corporation, provide more leverage. Their performance is usually like maybe about 1.6, 1.7 times the performance of spot gold prices. So hopefully you guys have taken a picture, and this is just our multi-asset view. So moving on to our final section, I'll talk about some of the top 2025 stock picks. And do remember, however, that this is for the US market only. So these are the 4 picks that we really, really like. You can see that there's a mixture of like more defensive stocks and more negatives, I would say underperforming stocks. Meta and Nvidia, companies that we think will be good to use your extra cash to dip buy. And then Coca-Cola and Netflix, companies that provide investors, we think, with some sense of stability moving forward. So to kick things off, I'll start with Meta Platforms. The Bloomberg 12-month target price was about 725. The last price I checked a few days ago, it was 484. So there's a 50% upside to consider and take into account. So Meta, again, not a very complicated company. You can see that I think about 98% of their revenue comes from advertising. A very, very small 1-2% comes from their reality labs division, their VR goggles and other things like that. Something that's very important for Meta is that they have billions and billions of users, and their daily active users, or what we call DAU, is about 3.35 billion. This number could be higher, and it's more than double that of like things like TikTok and WeChat. And these billions of users is very important because recall that for AI 2.0, we think that the biggest winners will be those who can monetize at a large scale, and having as big a user base as possible provides a company with opportunity to monetize their AI services at a larger scale, essentially offer their AI services to as many people as possible, and then generate more revenue from it. And for AI, if you guys have used like WhatsApp or Instagram, we see that they have their own AI model. It's called Llama. Uh, it's open source as well, and it's actually been I would say the company has been quite successful integrating it across its family of apps. Like you can see in this screenshot over here, Meta AI has been integrated into WhatsApp. And something very important and is that this AI integration has really helped boost their core advertising business. You can see that AI contributed to about 8% increase in time spent on Facebook and 6% increase on time spent on Instagram in 2024. And if you are working in the marketing field, these kind of numbers will make you very, very happy because this means that people are essentially staying in Instagram longer, and AI also helps essentially the company enhance their ad targeting, meaning that the right people see the right advertisements. For example, I work in the finance industry, so most of the advertisements I see on like Instagram, very, very strangely, or I would say very, very interestingly, they're all financial advertisements, and they base it based on your search history, based on who are your friends, for example, and then they will provide you essentially target specific ads that will suit your own personal profile. And why is more time spent on ads or more time in the app better? Because more time in the app again means that there's a higher likelihood that people and users see more advertisements. There's better targeting as well, means there's higher click-through rates, higher possibility that people will click on the advertisements. And if advertisements are more effective, advertisers will spend more advertisers will come to the app. So I won't delve too deep into the numbers, but some very key numbers as well. The operating margin is at the highest since fiscal year 2018. Average revenue per person as well is at an all-time high. Most of it as well is because of AI monetization. One of their key drivers is Facebook Reels, Instagram Reels. You guys have seen some of these Reels as well on social media. And a very key metric I think is very important for Meta as well is the price per ad, the price change per ad on a year-on-year basis. In the fourth quarter, it was up by about 14%. So average ad prices are higher. This is for the fifth straight quarter as well. And all this is really because of AI, which is really helping improve their core business. Remember that ads drive about 98% of Meta's revenue. So again, AI 2.0, who can best deliver AI at massive scale, who can lower the cost the most. This is very important. Uh, Again, Meta has a huge user base. It's expected to become the most widely used AI assistant, referring to Meta AI, because essentially it's integrated in all their apps like Instagram, WhatsApp, Facebook. It's very, very likely that that their AI assistant will become more widely used moving forward as well. And Meta also really they make their own custom chips, which essentially enables them to have lower cost for their AI. And this satisfies the second condition over here. They have their own custom inference chips. But however, I think it's pretty disappointing because I do think there's still a lot of opportunities. Monetization of AI outside of ads has been pretty slow as well. Of course, there are certain risk factors as well. Recently, they are involved in this antitrust trial where the Federal Trade Commission wants to essentially spin off Instagram and WhatsApp. tariff risk as well. So I would say that Meta, I would say, is moderately exposed to tariffs. They don't export or import hardware like Apple or Tesla, but the key thing here is that it will be affected by you know uh, a lower demand. If the economy slows down, businesses will cut spending, their marketing budgets essentially get trimmed, and businesses will spend less on advertisements. Some of the Chinese advertisers like Temu and Shein, they usually buy advertisements on like Facebook, for example, just to reach US customers, and we do expect them to pull back their spending because there's no point in them advertising to the US market when the tariffs are so high. There's no point in advertising to a market where you will likely not export to, in the end. So again, just a overall summary of Meta and its investment thesis. Again, we think it's the closest comparable to super apps like Alibaba, Tencent. Meta has also a massive user base. They have custom chips that lower their inference costs. AI is already embedded in most of their products and most of their apps, but there's still a lot more to explore in terms of monetization. I think they are looking to you know, um, have what we call sponsored search results. A bit like Google. So let's say you use Meta AI. Let's say you go Instagram. Let's say you search for I want to buy like a birthday cake. So we have what we call sponsored results, where a company essentially pays Meta to have their company appear at the top of the Meta AI search. So of course there's risk. Meta spends a lot in terms of capex, regulatory risk as well as tariff or recession risk. So the second company, hopefully I still have time, it will be Coca-Cola Company. Again, the stock is quite well performing, so there's only about 5% upside. Something interesting to note about Coca-Cola, they do not actually just, they don't sell just purely just the Coca-Cola can or Coca-Cola bottles. This is from the company's annual report. They do not plan to manufacture all of the product they distribute. What they actually do is that they sell the concentrate or the syrup of Coca-Cola, not the bottled drinks itself. They sell them to what we call bottlers or bottling partners, and these bottlers will essentially use that syrup or use that concentrate and then mix it with water, essentially to produce the final product. Of course, they do have finished product operations as well, but the concentrate business or the selling of the Coca-Cola syrup or Coca-Cola concentrate occupies a larger portion of their business. So we have a very, I think, interesting, an excellent business model, the bottler business model. They sell concentrate to licensed bottlers. You can see in this photo I've taken from their annual report. But to explain it very simply, uh, they essentially sell the concentrate or the Coca-Cola syrup to bottlers. They then combine it with carbonated water and then maybe add sweeteners just to produce the finished product. And then they'll package it into cans and bottles that have the Coca-Cola trademark. And then they'll sell and transport it to retailers directly or through other wholesalers. And this is a key, reason why Coca-Cola is able to essentially distribute their products across the entire world. And it's one big reason as well why you can find a Coca-Cola essentially everywhere you go. And this is very important because these bottlers, they handle all the very high capex high business operations like manufacturing, distribution, warehousing. They actually own their own warehouse as well, retail delivery, for example. Of course, this relationship is constrained by bottling agreements, but I won't dive too deep into that as well. So sometimes, I think the first question that always comes to my head when I look at this model, what is the benefit for the bottlers in doing what they do? So for Coca-Cola, again, they can avoid the very high capital costs, and this results in very, very high margins for them. Recall that Coca-Cola margins are actually pretty high, about 30% or close to 40%. And for the bottlers, however, they are essentially, not really legal partnerships or joint ventures. Again, this is from their annual report. They are independent contractors. So the main benefit is that they can leverage on Coca-Cola's advertising and marketing, as well as gain access to high recognition brands, like Coca-Cola, Fanta, and Sprite, without having to bear some global advertising costs. So Coca-Cola as a company, they do not really just sell Coca-Cola. They also have a lot of other products. You may not know that, for example, when you buy a Fanta grape, Sprite, Dasani, Minute Maid, Ayataka, you're actually also buying products from the Coca-Cola company as a whole. And just some specifics onto how their business works as well. Their products are divided into sparkling beverages like carbonated beverages, Coca-Cola, Diet Coke, Fanta, as well as still beverages. Still beverages means essentially beverages that are not carbonated, like Ayataka, Dasani, Aquarius. So again, if you go to any like Sheng Siong, Giant, you can see just the pure amount of products that comes from the Coca-Cola company, and just the number of products that we consume on a daily basis. Dasani plain water, Minute Maid, Ayataka, all other kinds of products. Financials wise, I won't dive too deep into this. The financials essentially performed really really well. Some key metric I like to share is what we call the price mix percentage. Essentially, it's just the price across the variety of Coca-Cola products. You can just think of it as the average price per product that Coca-Cola sells. The latest results in the fourth quarter, it's 9% higher, mainly because Coca-Cola hiked some of their prices. But we see that sales volume or unit case volume still increased, and this really tells us that as a brand, the company has very strong pricing power. And this is very important. This gives them their very defensive characteristic. Again, Coca-Cola is not only Coca-Cola, Dasani, Fanta, Ayataka. People who consume them, demand is very, very resilient. Something interesting as well is that the second and third quarter usually has the highest sales volume, and mainly because there's warmer weather conditions. Typically, it coincides with the summer period, and warmer weather conditions will improve the sales of some of their products as well. Their forecast for 2025 as well was better than estimates, and so financially, they are doing a very good job as well. So this is the investment overall investment thesis. Again, they by selling concentrates, they earn very high margin because they don't have to engage in the capital intensive operations and logistics. They can scale globally, distribute products all across the world without actually owning factories or trucks. Bottlers are essentially localized operators. And this diversified portfolio of brands, Fanta, Coca-Cola, Dasani, all of them will essentially help the company remain resilient, even during times of a downturn. It also has a very fancy title of a dividend king because it's raised its dividend payout or dividends per share for straight years. So they have a very huge priority on returning, money to shareholders. Their dividends on a 12-month yield basis is about 3.27%, which is pretty good as well. So again, massive brand power, asset-light model. They have a huge market share of the global carbonated drink market, about 45%. Of course, risk competition. Their main rival is Pepsi. Raw material costs, consumer preferences as well. Such as obesity, health consciousness. But we do see that the company is adapting. They come out with Coca-Cola Light, Diet Coke, Coke Zero, and other things like that. So moving on, hopefully I can cover enough time to cover the rest. We do have Netflix as well, 12% upside again. So I think something interesting about Netflix, it's being viewed as a big tech company rather than a media company. You can see that Disney and Warner Brothers, their stocks are down by over 20%. They have started from very humble origins at a DVD rental by mail. So they essentially send you DVDs by mail. It has about over 300 million subscribers. They are targeting about 110 million increase by 2030. So again, this chart I show over here, Netflix is 3 times larger than Disney. And again, like I mentioned, it's very, very interesting as well because it doesn't really trade or its financials aren't really in line with your typical media company. You can see in the white line over here, operating margin. Their latest operating margin is about 31.7%, very, very close to tech companies like Apple and Google at 34 and 32%. Their main, competitor, Disney, is at maybe about 15.9%. So Netflix is literally almost double that of their margins are essentially almost double that of Disney's. And we also like, as analysts, we also like to compare their margins to Spotify because of their very similar business model. Spotify also has like different tiers of subscription. There's a free subscription, and then they have like a paid subscription where you pay and then you don't listen to, and then you don't have to hear ads, for example. Spotify's margins are 11%. So again, their margins are very very unique, uh, at least for a media company. And I think one reason why the stock has done very very well is because it's being seen as a tariff haven. Again, they sell digital products. Uh, your TV shows, your favorite Netflix shows, they don't cross physical borders. So there's no reliance as well on like chips, shipping. They don't sell DVDs. It's just literally a digital product, and they don't have to import raw materials as well. And most usually, subscribers pay locally. Netflix will collect revenue in LCL. It's a industry term for local currency. For example, in Singapore, when you sign up for Netflix, you pay in SGD. There's also no exposure to commodity costs, so they are relatively well protected, I would say, from tariffs. And in their recent earnings, executives essentially said that Netflix is able to weather any economic turbulence from tariffs. I think this makes sense as well because it's very likely that Netflix will be one of the last services you'll forego if a recession happens. And key to this is that they are cheaper. Ad-supported tier will give users a downgrade option instead of fully cancelling it. So let's say the economy is very tough. You know, the economy undergoes a recession, and you are essentially tightening your pockets. And let's say currently in the US, you're on the standard plan at $17.99 per month. Currently you don't have to see any ads. Let's say your finances are very tight. All you can do instead of just canceling the plan, just simply downgrade to $7.99 per month. So it's a $10 difference. It's a lot cheaper, but you do have to bear with constant advertisements when you watch Netflix. So, just go through some financials as well. Their latest results just a couple of days ago. I think they hiked their prices recently as well in the US. 16% for standard plans, 14% for ad plans. And despite this, price hikes, we see that they beat estimates. Profit was about nearly 3 billion, about 24% year-on-year growth. Earnings per share also exceeded estimates. Most of it was driven by hits like UK series Adolescents and drama thriller Zero Day. I have to admit that I've probably never watched any of these shows, so I can't chip in any opinions on them. But operating margin as well is at 31.7%, so very very high margins as well. So something I like to share as well is that for Netflix, it's quite interesting because the fourth quarter typically has the lowest margins, and one main reason is also because fourth quarter is where usually they'll spend the most on marketing, spend the most on content production because it's the holiday season, and they want to market more, just to capture some of the more holiday, holiday audience, for example. And one key near-term catalyst, I think some of us may be pretty excited. The third season of Squid Game will be released on June 27. So it may help to boost the second quarter and third quarter. And their financial guidance as well is pretty good. They actually reaffirmed their forecasts despite all the recent tariffs and external risks in the economy. So this is very good as well because they are essentially saying that all this recent uncertainty in the markets will not impact their business, and we are sticking with our forecast. So these are our investment thesis. Again, you can see over here, these are some of the top shows. I just took a picture on Netflix in Singapore. So again, you can see this end sign over here. These are all original content. This is very important because essentially this means that shows like When Life Gives You Tangerines, I think it's very popular right now. You can only watch it on Netflix. And again, this is very, very important. And something key about all this, in-house production is that it's produced in country, in the country that it comes from. So, for example, When Life Gives You Tangerine, it's produced and shot in South Korea. I think fans will know that they did their shoot in Jeju. So all this results in lower production cost. It's a lot cheaper than in Hollywood, for example. And for example, the very famous Squid Game, it's produced for just about 21 million, and it's a lot less than just one single season of Stranger Things. Other shows as well, like The Glory, Lupin, it's a French show as well. They're all locally produced, so it comes with lower cost, but it's watched throughout the globe. So this in-country production is very important, and I think it's what gives them their advantage over other streaming companies like Disney. So these are investment thesis as well. Streaming dominance, asset-light model. This ad supported tier is very important. Again, they bring in margin, they bring in revenue from advertisers. This was just launched recently in 2022. It's actually what's driving most of the newer signups. I mean, of course, if you were to ask me today to sign up for Netflix, I'll straight away opt for the ad-supported tier. I'm not sure if it's available in Singapore as well. And however, I think the data shows that it still accounts for less than 5% of total revenue. So there's a lot more room for growth, especially for Netflix, to essentially increase their advertising revenue. So again, the financials were very good despite recent price hikes. So it shows that Netflix users are still, essentially they have pricing power. Netflix has pricing power over their users. Recently they also expanded into live sports events like WWE, NFL, and this is very important. I think this will drive their next, their advertising business, because during live events, it doesn't matter if you're on, the ad-free plans. It doesn't matter if you're paying the $17 plans. You still have to see all the commercial breaks, all the advertisements as well. So this is key to watch as well. And margin expansion, your margin has been increasing. In 2024, it was 27%. This was after a 6% jump from 2023. And now recently, I think 2025, they're targeting about 29%. Risk factors are, of course, competition with other streaming and forex risk as well, as well as performance risk, the risk that their content that they produce doesn't perform well. So now onto the last company, Nvidia. Again, the stock is, I think last when I checked, it was below $100. So the target price about 165. It's a 70% upside. Again, probably an ideal company if you have extra cash and you want to dip buy on beaten down stocks in the US market. So again, this is from their recent company presentation. They do have four main segments. The key segment here is the data center segment. It made up about 78% of their 2024 revenue. So something I'd like to share as well. I think there's a misconception that Nvidia sells individual chips. Uh, they actually sell what we call full systems. You can see over this line over here, they sell things like the DGX, HGX, MGX systems. DGX essentially is for deep learning. It's essentially the best, I would say the best in class system for AI development. So you can see in a way that individual chips, you can see it as like having a car engine. On its own, it's pretty useless. I mean, if you were to buy a individual GPU, there's essentially nothing you can do with it. It's just a piece of metal. However, buying a full system, essentially you're like buying a full car by itself. The entire car itself is ready to use. You can just hop in and then just start driving the car. So this is very similar to the full systems as well. The full systems doesn't only have GPU, it has the CPU, it has the DPU, the data processing units, networking chips, meaning the chips that essentially connect all the multiple kinds of chips into one single functioning brain, as well as the very important NVIDIA AI software, which I'll elaborate more later. And something to add as well, the full systems typically contains like thousands of GPUs, thousands of different kinds of chips. So it's not just individual chips. And that's why one reason as well why NVIDIA has performed so well last year and why it's one of the best beneficiaries, AI, mainly because these full systems contains tens of thousands of chips, and one chip itself can go as high as $40,000. So again, don't think I have to share much on this. GPUs are preferred for AI because it's 70 times faster than CPUs. And this is the best, this is why it's considered the best in class chips for the AI development. So the key point, or one reason why I really like NVIDIA, because it really doesn't just sell chips, it sells what we call an ecosystem. Again, they do have like inference GPUs like the L4 and A10, but they do have a key competitive moat in the CUDA, software framework. and QDNN. So just to explain it, originally the NVIDIA GPUs, graphic processing units, they were actually originally made for games, video games, for example. They render the high resolution graphics, but with this CUDA software framework, essentially allows developers to convert the GPUs into usage, being usable for AI instead of just video game graphics. So essentially, it made uh, you know NVIDIA chips from video game chips into AI chips. And then we have the CUDNN. Essentially, it's like a recipe book. Uh, if you want to develop AI, it presents you with ready-to-use instructions on how to build AI models. So again, their software stack, you can really see it as like Apple's iOS App Store, where if you were to create a mobile app, most of the time when developers create a mobile app, they go in with an assumption that the app will be built or essentially will be sold on the Apple App Store. And it's very similar to NVIDIA as well. So let me explain. Again, CUDA is a software that lets NVIDIA's GPUs do AI instead of just graphics. Very key first step. But again, if you want to develop AI, you don't just use CUDA. There's specific tools like PyTorch and TensorFlow. Some of you like computer science majors or like IT majors probably have seen some of these tools before. And the key thing is that whenever a developer use PyTorch, the the tool itself will automatically try to use NVIDIA GPUs via CUDA. Again, CUDA can only be used through NVIDIA GPUs. If your AI model doesn't have an NVIDIA GPU, you'll essentially reroute and fall back to a CPU. And this is again very similar to the logic behind mobile apps and Apple App Store, because the tool PyTorch was developed and created assuming that developers will essentially work using NVIDIA's chips. And again, this not only just for the training stage as well, it's only in the inference stage. Uh, something to I want to highlight again without going too complex. There's a tool called TensorRT where CUDA is used to compress AI models. You may have seen like ChatGPT Mini, O4, O3 Mini, and usually developers will use tools like this to compress the model, for deployment at scale. But again, all these tools and all these apps, models, everything that I mentioned, it only works on NVIDIA GPUs because CUDA or any software essentially assumes that you will be using NVIDIA's GPUs. So again, most AI development software was built to work with CUDA by default. It essentially just assumes you use NVIDIA GPUs, just like how mobile apps assume they will work and they will sell on the Apple App Store. There are other competing software tools like AMD's ROC M, but they are far less supported. They are not as comprehensive as NVIDIA's CUDA. So again, the key point here is that any developer who has built AI software, they're probably using CUDA or any other tools related. And really, this is why, there's a lot of reports recently on, Chinese companies, they're still ordering NVIDIA chips. Recently, CEO Jensen Huang went to China for a meeting with some of the uh, politicians and business leaders. So their chips are still very, very important. The only impact that DeepSeek will have most likely is just, purely in terms of their pricing. But Nvidia still has a lot of competitive advantages, and their chips are still essentially crucial, and Chinese companies are still using it. Even DeepSeek itself was built based on some of Nvidia's older H20 chips, which are now banned. So again, a lot of the Chinese models like Alibaba's Kuan, Tencent's Hunyuan, and ByteDance Doubao, they're all trained on PyTorch, which I mentioned. So NVIDIA's chips are vital. It's very, very important. CUDA is proprietary as well. So NVIDIA, AI developers who build AI models using CUDA, they are essentially tied, they are locked into NVIDIA's GPUs. And competing hardware like AMD, custom chips, they cannot run any CUDA-based software. So these are investment theses as well. I think China risk is something that's on top of mind for investors. Uh, they do have however, I think a very, very good track record. They have constantly developed new chips to, essentially just go around export restrictions. They first came out with A800, and then the US, administration came out with additional curbs, and then they proceeded to develop H800, and then more recently, the latest one was H20. So we do expect them to eventually just create just new chips, just to meet the newest export restrictions. This is very important because they'll still maintain relationships with Chinese customers, and Chinese customers will not essentially switch to other providers. And more recently, after the H20 curbs, from our financial modeling and forecast, there's a risk that they could lose revenue of up to $8 billion. That the percentage of revenue from China drops from 13% in 2025 to 2024, which is the lowest it was in the first quarter of 2024. However, it's important to note that previously China actually made up about 20% of the business, but recently we are seeing that this reliance on China as a market is going down. So again, something to monitor as well, but its risk, I would say, is slowly decreasing, at least its impact on NVIDIA's overall business. Something we really like as well, they have a very, I would say, unique 12, 18-month product refresh cycle. So every 1.5 year, they'll come up with new innovative products. There was a GTC 2025 keynote address recently, where they essentially just outline their future products as well. I think you guys probably have heard of Blackwell. It's the newest chip architecture. And after Blackwell, you'll come up with Rubin Vera. And even after that, we have the Feynman chips as well. So they have a very good, I would say, excellent product roadmap. And every 12, 18 months as well, they'll introduce new chips. They also have other chips for robotics, and even their new RTX chips as well could help them in their other segments or their non-data center segments. Again, I'd like to highlight this again. Chinese companies are still using NVIDIA. DeepSeek doesn't just mean that NVIDIA is useless. After all, their software stack is very, very important for AI developers to scale up. The whole point of the whole software stack is makes AI development a lot easier. And however, it comes with a caveat that all this CUDA software essentially only runs on NVIDIA's GPUs. New markets, for example, automotive, robotics, gaming, uh, do allow them the opportunity to diversify outside of cloud service providers. A lot of their revenue recently comes from cloud service providers like Microsoft, Meta, Amazon, for example. But some of the recent events, we do see that they are expanding their customers. Telco companies, robotic companies, even other hardware companies to make an AI supercomputer. So again, things look very bright, but of course, as a semiconductor stock, it's very exposed to tariffs, which is why prices are down. But again, if tariffs get de-escalated, there's a very high potential for upside, 70% upside. So again, a very good stock if you guys want to deep buy. And with that, I'll end the presentation. Sorry if it took a little bit too long, but I do hope that you guys have learned something new today, and hopefully I've covered everything I needed to. So if you guys have any questions, do feel free to email me. But if you guys want the slides, you guys can contact Marcoms. And yep. So now we'll just move on to the Q&A session. Let me go to the Q&A.
All right, Danish, I think we haven't received any questions tonight.
Okay.
So while we have exceeded our time. So while we do not have enough time for a live Q&A session tonight, I think our viewers can send in any questions they may have for you via the survey that will
Yep.
pop up
Yep.
later.
Yep.
Yep. Yep. So before we end the session, let me bring my screen up again to quickly share this ongoing promotion we have. One second. Alright, I think my screen is visible now. So from now to 30th June, you can trade any popular US stocks. Sorry, you can trade the popular US stocks and ETFs like Tesla, Amazon, Nvidia, QQQ, the ones that Danish have mentioned just now, at a price of only $1.88. And you can scan the QR code on the screen to learn more about this exclusive promotion. And with that, we have come to the end of the webinar. Thank you again, Danish, for the sharing, and thank you everybody for your time tuning into this webinar tonight. And once again, feel free to send in your questions via the survey that will be popping up after the session ends, and we will get back to you as soon as we can. And we'll also be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. And that's all for tonight. Thank you and have a good night.